Hi, I'm Miles Roberts, the Group Chief Executive at Smith, and today we're absolutely delighted to show our half-year results for the period to the end of October 22. And the performance during this 6-month period has been very strong. It's really benefited from our constant focus on our customers' changing needs during a time of what has been really significant economic volatility. And this is in no small part as a result of the huge efforts that everyone in Smith has made. And I would like to thank all of our colleagues for their efforts over this period. In a challenging macroeconomic environment, our comprehensive geographic footprint, combined with our high security of supply, our levels of service, have driven an ongoing gain in market share. So for the 6-month period to the end of October, our revenue grew to just under £4.3 billion, up 26% on the comparative period. And adjusting operating profit has increased by 49% to £418 million, both on a constant currency basis. And we're particularly pleased with the performance of our Southern European region. This continues to reap major benefits from our acquisition of Europac back in 2019.
Hello, I'm Adrian Marsh, Group Finance Director. I'm extremely pleased with our performance over the past 6 months, and we're now back on the trajectory we were on prior to COVID. Our strong performance is particularly reflected in the 400 basis point improvement in our key financial metric of return on average capital employed. This now sits at 13.2%, which is well within our medium-term target of 12 to 15%. Cash generation has continued to be strong, helping to drive down both our absolute level of debt and also our leverage ratio of net debt to EBITDA, which is now at 1 times and well within our medium-term target of 2 times, and reflects our strong balance sheet and excellent financial position. Our overall financial performance has led to adjusted basic earnings per share growing by 49% on a constant currency basis to 20.9 pence. As a result of the volatile and inflationary environment, we saw input costs increase by £779 million versus the comparable period, with price rises in raw materials and other costs, particularly paper, OCC, starch, labour, distribution and energy. We've been very well placed to avoid the extremes of this volatility in our cost base with our excellent procurement and risk management functions, particularly in relation to starch and energy. Despite this price volatility and the continuance of global supply chain disruption, we've avoided any impact on our production.
Whilst we've continued to take market share, our volumes did show a decline of 3% over the same period last year. Now this is lower than we originally expected, and it's largely due to weakness in the industrial sector, whilst the FMCG sector, where we're overweight and in a leadership position, that remained much more resilient. And during the period, we've seen significant input cost inflation. However, we've dealt with this well through our cost mitigation programs and processes, but also where necessary through price increases to our customers. And our customer remains our primary focus. We've continued to invest heavily in the company, centred around firstly the capability and the efficiency of our operations, but also investing behind new innovation, new sustainability, and also our digital platform, all being demanded by our customers. I was particularly pleased to have opened our new greenfield sites in Italy and Poland in September. These new assets are absolutely fantastic and they're performing very well ahead of the original business case. And of course, sustainability has been at the heart of our business model for many years, and we've developed and grown into a solely fibre-based corrugated packaging business. We've now replaced over 520 million units of plastic packaging with corrugated since 2020. So ultimately, the structural drivers for corrugated fibre-based packaging remain stronger than ever. And our performance during the first half combined with a real strengthening of our relationships with our customers and our enhanced investment program, give us confidence to raise our expectations for the current year, but also set us up very well for the coming financial year. And on the back of this, I'm very pleased to announce a significant increase in our interim dividend, which is fully consistent with our dividend policy of a cover of 2 to 2.5 times, and also in line with our increased earnings. So thank you very much for your time. Thank you.